Morning, good morning. We'll give it another minute to allow late arrivals.
Okay, thank you.
You're welcome.
Good morning. Good morning. Thanks for joining Sorority Sinkfield.
Good morning.
Well, we'll go ahead and get our fall financial seminar started with the prayer. Sarah Sinkfield.
Good morning, everyone. Let us pray. Most gracious and holy God, we just thank you for this beautiful day, God, and we thank you for this opportunity to come together to hear what we need to do to work on our finances and home ownership. God, we just ask that you would bless every person that is on this call, those that will be leading us, those that will be facilitating the discussion, and the experts that will be sharing information with us. Lord, we're so grateful for this committee and this chapter and for all that you will be doing throughout. Lord, we ask all of these things. In Jesus' name we pray. Amen.
Amen. Good morning. I am LaShawn Gonzalez, the second Vice President of East Point College Park, Delta Sigma Theta Sorority Incorporated. I bring you greetings on behalf of our illustrious president, my soror, Joyce Wilson. Welcome to the Keys to Legacy, a guide to home ownership and refinancing. The panelist has a wealth of knowledge to share with you today. So I hope you will intake all that they have to offer and enjoy. I want to thank you for joining us today. And I will now turn it over to our moderator, Ms. Deborah Kennedy. Thank you for coming.
Thank you, Sarah. Thank you. Well, again, good morning. I will be your moderator this morning. I am Sarah Deborah Kennedy. And as a public service organization, Delta Sigma Theta Sorority provides an extensive array of public service initiatives through our 5-point programmatic thrust: economic development, educational development, international awareness and involvement, physical and mental health, and political awareness and involvement, better known as social action. Under our economic development banner is our Financial Fortitude Initiative. It is this initiative, Financial Fortitude, that brings us here today. Our goal is to spread financial education throughout our local communities. So today, the Economic Development Committee of East Point College Park Alumnae chapter of Delta Sigma Theta Sorority is pleased to bring you our fall financial seminar, Keys to Legacy, a guide to home ownership and refinancing. In a minute, I will introduce our speakers for this morning, but before I do that, I wanted to explain how our session will proceed. During today's session, the only people that you will be seen and heard are the presenters and myself, the moderator. You will be able to ask questions, and we encourage you to do so. However, you will need to use the QA button, which is located at the bottom or top of your screen, depending on your device. To ensure we stay on time, we will answer all our questions at the end of the session. However, you don't have to wait until the end to type your questions. In fact, we encourage you to type in your questions as they come to you. Additionally, any comments you may have, please enter into the chat box. So we're going to go ahead right now and use the chat box. I'm asking you if you would locate your chat box and enter in your current home status. Are you a future homeowner, a current homeowner, an investor, or are you looking to refinance? So let's just use our chat. I see we got some future homeowners on here. We've got current homeowners, okay? And we just got looking to refinance. So we're going to touch a little of everything for everyone. Great. So we are so happy to have current homeowners and investors on here and the future homeowners. And absolutely, we will definitely have information on refinancing. So great. Also, at the end of each one of our sessions, we will have a quiz. Each one of our segments, we will have a quiz. And so pay close attention because at the end of each session with the quiz, you'll have a chance to win a gift card. Okay. Lastly, at the end of the session, we will have a survey. We'd like for you to complete that as we want to get your feedback about today's session. A link will be placed in the chat for access, but also the survey will be up on the screen at the conclusion. And we'd appreciate if you would stick around and give us your thoughts. Now, before our guests come, let me tell you a little bit about them. Today we have Sora Joni Jefferson. Joni has been a licensed realtor since 2020. She believes community can build generational wealth through real estate. Her passion stems from her own journey toward financial freedom through real estate. Therefore, she started Keys by Kness to help our community achieve wealth through property ownership, advocacy, and education. Then we have Sarah Allison McCorden. Allison is a licensed mortgage loan originator and a branch manager with American Financial Network. With over a decade of experience in mortgage lending and finance, Allison is passionate about creating homeowners and educating others about mortgage financing options available. Her branch, the McCarden Mortgage Group, allows her to lead a team of loan officers dedicated to increasing generational wealth through home ownership. Lisa McKenzie. Lisa is a certified real estate appraiser with over 26 years of experience in real estate industry. With 5 years as a quality control appraiser auditor, 2 years as a realtor, and an active appraiser today, Lisa has developed a well-rounded perspective on the housing market and a deep understanding of what buyers and sellers truly need. Lisa is passionate about helping future homeowners achieve their real estate goals while ensuring they feel confident in their decisions. Her mission is to simplify the process, making it easy to understand and as stress-free as possible for everyone she works with. And then we have Kirsten Matthews. Kirsten is a Georgia bar attorney with the Halls Law Firm. She began her legal career in family law before being invited by the firm's founder to explore real estate, a field she's passionately practiced ever since. With over a decade of experience, Kirsten has helped countless clients navigate the complexity of the closing process, demystifying the documents and procedures involved in real estate transactions. Driven by the belief that knowledge is power, Kirsten is committed to educating her clients, empowering them to make informed decisions that foster economic growth and stability. Today, she leads the firm's Southside office, proudly serving as hashtag everyone's favorite mobile closing attorney, trusted, approachable, and beloved by the community. So, without further ado, I turn it over to Joni.
Good morning, good morning, good morning, and thank you again for joining us. So I'll start our session off today as your realtor. And we want to start by letting you know that the realtor is your guide through the entire transaction. Next slide, please. So here we have displayed the wheel for home ownership. So this is a general overview that shows you the major steps in becoming a homeowner. So first we'll start at 12 o'clock, well, a little bit after 12 o'clock, where you meet with a real estate professional like myself. And it is important that you choose a realtor with industry experience. Then you're going to get pre-approved, search for homes, make an offer, negotiate, and bind your contract. Once your contract is binded, you can enter into escrow, where the final details, which will be brought by our closing attorney, and then you make it to the closing table. And congratulations, you're a homeowner. Next slide, please. Now, what should your agent do for you? When you hire a real estate agent, they'll ask you to sign a buyer brokerage agreement, which is also known as a BBA. Under this agreement between you and your agent, these are the things listed here that an agent is legally obligated to do. We are to make all disclosures and comply with all real estate laws, locate suitable properties for the buyer to purchase, assist only to the extent requested by the buyer, and negotiate with your contracts and get your contracts completed. Additionally, a great agent will always keep you focused on your goal. We'll advise you on the real estate market, including stats, counter offers on the properties that you're interested in. We also coordinate inspections and maintain deadlines. Additionally, we're also a listening ear. We'll be your shoulder to cry on for tears, your confidant, and most of the time, your agent will become a trusted friend. Next slide, please. So once you have been pre-approved and that information will be brought to you by our lender, we'll begin the search for homes. So now that you've hired an agent such as myself and gotten pre-approved, it's time to start shopping. Things to consider: your future as well as your current needs. Consider your finances, because we don't want anyone to be what we call house poor, right? We only want you to focus on homes that are within your budget at mortgage payments that you can comfortably afford. We'll analyze the market, property taxes, and utilities for the area which you plan on buying. We'll help you research the schools or give you tools to do so. Check out local amenities. Maybe your HOA may offer a swim or tennis community. There may be public transportation and parking, and we'll also help you with your commute to work. There's available crime statistics for you, and we also encourage you to visit your neighborhood in person on different times of the day and different days of the week, right? Because a neighborhood could be more lively on a Saturday night than a Monday morning. So before you purchase a home or choose a neighborhood, you want to know what you are moving into. Some key things that we always like to remind our clients is location, 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 right? Where do you want to purchase this home? Is the area growing in the next 5 to 10 years? Are there major developments or employers coming into the area? What do those things cost and how do they affect the housing market in that location? Next, we'll consider the size. How big is your family? Are you considering expanding your family in the near future? What type of home would you like? Two-story, ranch? Would you like a basement or a man cave? Right? And what other optional features are must-haves for you and your family? Next slide, please. So once we've searched all of the available properties within your budget and location must-haves, then we will do a market analysis and pricing, right? We will determine what is fair market value for this home, which will help you in your offer price. We compare similar properties that may have sold within a 1-mile radius or even down to the same subdivision as the property that you're interested in, again, to make sure that this home is listed for fair market value and you are comfortable with the offer that you're making. We'll consider neighborhood trends. Like I said before, is this neighborhood growing? Are there businesses or employers coming into the area? And what school district is this home located in? Will also help buyers avoid overpaying and overbidding for a property. Next slide, please. Now that you found the property and we negotiated a price, now we're going to assist you with submitting an offer on the property. Once the seller and the buyer agree on a purchase price, the contract is signed and becomes binding, and all the terms set in the contract become effective. One thing to always remember in real estate is time is of the essence, right? You may have a financing contingency where you need to get your financing approved within a certain amount of time. Same as your appraisals and your inspections. So always remember, in real estate, time is of the essence. Next slide, please. Now, once the contract is bounded, you enter into a due diligence period where these contingencies, common ones listed here, are of the essence, right? So now this due diligence period is where the buyer has the time, which is usually 7 to 10, can be more or less depending on your situation. You have your due diligence to inspect the property to make sure that there are no latent defects. Some common inspections are septic, plumbing, roof, termites, your land survey so that you know exactly where your property will stop and start. Other contingencies, as I alluded to before, may be your financing contingency, your appraisal, your title, and HOA. These things must be done during your due diligence period so that you can uncover any latent defects and you can use this as negotiating power with your seller. Next slide, please. Now, it's time for a fun quiz. So we'll take this one to our Zoom participants. So type in the chat for us the answer to this question. What is a realtor contracted to do under a signed buyer brokerage agreement? Is it A, connect you with the lender and find homes? B, comply with all laws, make all disclosures, find homes, and negotiate on your behalf? C, drive you to homes, give you advice, and be a friend? Or D, provide market analysis, crime statistics, and school ratings? So our chat monitors will get our first winner and they'll let us know who won, and we'll be sending you a gift card.
Looks like our winner is Miss Candace Thompson, and we will connect with you via private message, Miss Candace.
Congratulations, Miss Thompson. You've won a $25 gift card. And like Miss Greer said, she'll get your information and we'll send that over to you. So thank you all for listening to the Realtor portion of this webinar. And next up, I will turn it over to our trusted mortgage lender and my soror, Miss Allison McCartan, who will be bringing you information on the mortgage approval process. Allison?
Thank you. All right, so good morning, everybody. The fun part, everyone loves to talk about money. All right, so my name is Allison McCartan. I am a branch manager and licensed mortgage loan originator with American Financial Network. And if you ask my mother how long I've been doing mortgages, she will tell you that I've been doing it since I was 3 years old. Because I grew up in the mortgage offices, I'm a second generation mortgage professional, and I love educating people about the mortgage process and the mortgage industry. All right. So let's talk about pre-approval. Whenever you decide that you're trying to purchase a home, you want to get pre-approved. I always advise that people get pre-approved at least 6 months to a year prior to shopping. That way you can address any red flags, or you can get an understanding of the process and what will be needed for you to get to the closing table. Because with a pre-approval, the closing table is the goal. All right, so we're going to talk about some of the top 3 things that a pre-approval will provide you, and we'll discuss what a pre-approval is and the mortgage process. A pre-approval allows you to shop with confidence. So during this process, it's going to be very important that you understand what is going to be expected of you. The loan amount, I always say that buyers are most concerned, how much am I eligible for? What will my monthly payment be? And what will my interest rate be? But there's so much that goes into a mortgage loan. So you want to make sure that when you're shopping, you have an understanding of what you qualify for. There are also going to be fewer obstacles. So some of you may have heard of a pre-qualification. A pre-qualification is more so stated incomes. When you put on an application, anything with a number. So I say that I make $10,000 a month. I'm telling you that I have $20,000. But during a pre-approval, anything with a number is going to be verified with documentation. So that means your income is going to be calculated in accordance to mortgage guidelines. Let's say if you have variable income, there's going to be certain ways that that income has to be calculated. And many people feel like, hey, if I give the lender a lot of hours work, that's going to impact my pre-approval. But in many cases, your income is averaged if you have variable income. So that's an example of some obstacles that can be addressed during the pre-approval process, because a licensed mortgage loan originator is going to thoroughly review your application and documents to make sure that everything aligns and address any obstacles. Credibility. Your pre-approval lets the seller know that you are ready to buy. It ensures that that loan originator, that's name, and also their license number is on the pre-approval, has thoroughly evaluated your financial situation to say, hey, this person has the green light to purchase this home in this price range. And that is going to be very important, especially in a competitive market. All right, next slide. Okay, so mortgage programs. There are so many different mortgage programs available. Most of the times when you think that you want to purchase a home, you may go to your local bank. Your bank specializes in checking accounts, savings accounts, credit cards, and they may have a few programs. However, there are mortgage lenders that specialize in mortgage programs, and they have a plethora of options for you. But there are some common programs that you want to know about. That way, when you're talking to your mortgage professional, you can let them know certain things about your financial situation. All right. So, a conventional loan, this is a non-government loan. I like to say that this is an all other umbrella. If you're purchasing a primary residence, a second home, an investment property, this can be a conventional loan, as well as multi-unit. Typically, the minimum credit score is going to be 620, and your down payment, it varies based on your situation, right? If you're a first-time home buyer, you may be eligible to put down 3% with a conventional loan, or even if you haven't owned a home in the past 3 years. If you have owned a home in the past 3 years and you're looking to purchase a primary residence, then the minimum down payment will be 5%. Second homes, they start at 10% down, and investment properties for conventional, they start at 15% down. So conventional is like an umbrella, depending on your financial situation and what you're looking to do, that may be a good option for you. An FHA loan, that is a government loan. It allows clients who have, let's say, lower credit scores or maybe higher debt to income ratios to qualify for a mortgage. Typically, the minimum credit score is 580 for most lenders. That allows you to put down 3.5% down. However, FHA, you can go down to 500 with several lenders. The thing that you want to know is that if your credit score is less than 580, you have to put down a minimum down payment of 10% down. But it is still good to know, because sometimes there might be a situation where someone is selling their home and their credit isn't where they need to be, and they're going to have that extra capital or assets to put down a larger down payment and purchase a new home. USDA loans, that is going to be a government loan that allows you to purchase in a rural area. And it can't be what you think is a rural area. There's actually a website. You're going to go to the USDA website. You have to put in the property address, and it will let you know if your property is eligible for USDA financing. For most lenders, the minimum credit score is 620. However, there are some cases where lenders can go down to 600. So again, that's why the pre-approval process is so important, because sometimes you'll find information online and it may be a common overlay, right? An overlay is basically a standard that a bank sets as a minimum score, but there might be other mortgage lenders that have more flexible guidelines and can still insure that product. An adjustable rate mortgage. So there are fixed rate mortgages and then there are adjustable. So that's going to go up and down based on the market. But it is a good option to understand and price those items. If we're in a volatile market, you may want to consider an adjustable rate mortgage. The minimum score is typically going to be 620. And the down payment varies, as you can see, typically between 5% down to 20% down is the average. VA loans, that is a government loan, so that allows veterans to get into a home with 0% down. Now, it is important that with all of these programs, when we're looking at the down payment, that's the down payment. However, there are closing costs when you are purchasing a home. So you want to make sure that in this market for purchases, they average typically around 4% to 5% of the purchase price. And when I'm working with veterans who are interested in VA loans, sometimes they don't factor in the closing costs. So again, you want to make sure that you get pre-approved so that way your lender can discuss these items. And the minimum credit score for most VA, well, actually, VA does not have a minimum credit score. However, there may be overlays, and a lot of lenders have a minimum score of 500 for VA loans. And to qualify, we need a certificate of eligibility form that you get from the VA. All right. But as you can see at the bottom, the disclaimer, these are going to be your traditional mortgage programs. There are several non-traditional mortgage programs that you may be eligible for. So it's always good to, again, consult with a mortgage professional. There are bank statement loans, DSCR loans for investors, fix and flip loans, construction loans. We have access to a plethora of loan programs. So definitely do your research. And next slide. All right, so what affects the loan approval in a typical mortgage process? Income, assets, and credit, or in order, assets, credit, and income. You have to submit all of your documents to the lender. On that chart, you can take a look and see some of the common documents provided, but typically you're going to get a link to complete an application and a checklist of documents needed. You're going to submit these items, and typically you should get an update within 24 to 48 hours, and you can have a conversation about which program best fits your needs. Once you're pre-approved and you start shopping for a home and you go under contract, your loan is basically on pause, right? So that means you don't want to change your financial situation because your pre-approval was based on your bank statements at the time. It was based on your pay stubs. And this is a snapshot of your situation. Now, once you go under contract, your loan is going to be submitted to underwriting for underwriting approval. So depending on how long it took for you to shop and purchase a home, we may need updated documents. We may need updated pay stubs. We may need updated bank statements. And you will be surprised that sometimes I get updated bank statements and I'm like, where did the money go? So you want to make sure that you keep your funds, keep everything the same while you're shopping. Don't spend your funds because having reserves can also impact your pre-approval. Okay, and reserves, that is going to be money that is in your account after your funds for closing. There are some situations where a client is buying a house and hey, this is everything that I have. I'm not going to have reserves. So it's important that when you're getting pre-approved, that they're evaluating your situation as it's going to be when you go under contract, and that underwriter is just crossing their T's and dotting their I's during the mortgage process for every single thing that is listed on the application related to assets, credit, and income. So once the underwriter verifies everything, we're getting a verification of employment, getting your tax transcripts. There are certain fraud reports that are pulled during the mortgage process. There are situations where, we see everything. We get your entire life. So during the mortgage process, it's typically about 21 to 30 days on average. But we are crossing your T's and dotting your I's for everything, your 2 years of employment history. And some people do ask, do I have to be with the same employer for 2 years? You don't have to. We just need to document an employment history. And in some cases, your employment history may need to align. There may be situations where we can use education to complete your employment history. We need to make sure that you have a 2-year residence history. Did you pay rent? If you paid rent, always list it on the application. Some people don't, but everything with a number matters because the system may see okay, this person is having a minimal increase in housing. That can help your pre-approval. And ensure that you have sufficient funds for closing. Funds for closing can come from gifts from a family member, but we, of course, have to document where the money is coming from, keeping a paper trail. There's down payment assistance options that can assist with funds for closing. The seller can contribute. And even with seller contributions, the mortgage process is very detailed. So depending on the program, there's a maximum percentage that sellers can contribute based on the program. For example, for FHA loans, a seller can contribute a maximum of up to 6% towards a buyer's closing costs. For VA loans, they can only contribute 4%. For conventional, it depends on the down payment. So if the down payment is less than 10% down, then the sellers can contribute a maximum of 3%. So there is so much that goes into a mortgage process. But once we go through and you get that underwriting approval, we have verified your conditions, all of the requirements from the underwriter, and we have an appraisal, which the appraisal will discuss, and we have a clear title, which our closing attorney will discuss. You get a clear to close. That is when everyone celebrates. You may shed tears. It may be a hard process. Um, but you get your clear to close and you are able to close. Nothing closes without the money. Next slide. All right, so let's get into refinancing. So refinancing, it is actually what it says. You are going to refinance your existing mortgage. So that may be changing your interest rate, your terms. You may want to stretch out your monthly payment back to a 30-year fixed to lower your monthly payment. And your current mortgage is paid off, and now you have a new mortgage. All right. So when refinancing, here are some ways to see, is refinancing right for you? You may be looking to renovate or improve your home. Your home has equity. You may be looking to consolidate your debt. Right now, so many people are in debt just because post-pandemic, we know that there's been layoffs, there's been so much. So we have had to rely a lot on credit. However, you can refinance and consolidate all of these multiple interest rates that you have into one monthly payment and one interest rate. Cash out for school or medical bills, lower your monthly payment and or interest rate, or shorten the loan or change the loan product. There are situations where, let's say if you have an FHA loan, there's mortgage insurance that you have to pay. Mortgage insurance protects the lender. It's an additional amount that is added to your monthly payment. That is for the life of the loan. With conventional loans, when you have 80% or less loan to value, you don't have mortgage insurance. So someone may refinance from a FHA loan to a conventional loan to drop mortgage insurance and lower their monthly payment. That's an example of changing your program. All right, next slide. So here are some options that you want to consider. It's going to be very important that we understand the refinance process, because when there are refinance booms, which we hope will happen, you want to make sure that you're prepared and you want to know, okay, what does it mean? What does all of this mean? When rates went down to 2 and 3%, everyone that had a home should have refinanced, right? Because we don't know if rates will go back then. Hopefully, but we don't know. For the past few years, interest rates, they have been relatively higher. So 6%, 5%, 8%. If you have purchased in the past 3 years and you're hearing talks of interest rates going down, you want to know, okay, what type of refinance do I want to do? Typically, you're going to consider a rate term refinance. That is going to be lowering your monthly payment. That is the goal. You don't want to take cash out. So with a rate term, you may benefit by getting a lower interest rate than you currently have, extending your mortgage to a 30-year fixed. Do you have to extend your mortgage? No. Some people are like, hey, I want the timer to stay the same. So maybe you've had your home for 10 years. You can do a 20-year term. You can do a 15-year term. There are multiple options. If you're getting cash out less than $2,000 at the closing table, that is going to be considered a rate term. It's going to all fall under rate term. And you can roll in your closing cost as well. So essentially, if you have the equity, you don't have to come out of pocket with a rate term refinance or a cash out refinance. Now, if your goal is to use your equity to your advantage, you hear a lot of talk about equity, equity, equity. If you have a home, your home appreciates in value. So you can take out the equity. Usually there's going to be limits. Let's say 75% loan to value is going to be a standard, or maybe 20%. You can take out up to whatever the allowed loan to value is. And that can be to consolidate debt, to do home improvements, to fund a business project. You just have to disclose to the lender what your intention is with the cash. But in many cases, a cash out refinance may be a good option for you. So the actual programs that you want to be on alert for these are just a few options. Again, check with your mortgage professional because there are many. FHA Streamline. So that means you're going from an FHA loan to another FHA loan, right? FHA to FHA Streamline, they only look at your mortgage report, your mortgage credit report. So maybe life has changed and your income situation has changed, and you're like, hey, I don't know if I can qualify for a home now. I qualified back then, but things have changed. But I do want to take advantage of the lower interest rates. Consider an FHA Streamline refinance. Let's say if it's a situation where you don't want to do a cash out refinance, maybe you don't qualify for a cash out refinance, but you need to take care of some home improvements. There's an FHA 203K loan. FHA is going to have flexible requirements when it comes to qualifying. You can do a 203K refinance. Some people think you can only do it on a purchase, and you're going to document the repairs that you're going to make, and the property will be appraised based on future value. And as long as you qualify for that loan amount, then you're good to go. Conventional refinance, again, conventional is an umbrella of all others. Depends on your occupancy type, equity, conventional. Okay, it's not a government loan, so it is going to be more so investor based, not investor as far as a homeowner, but the guidelines are not backed by government. Okay, and then similar to an FHA Streamline, a VA IRRL. So you're going from VA to VA, and you may qualify for a lower interest rate. They're not going to look at your information the same as they would. They're going to look at your mortgage report, and those are the options that you want to be on the lookout for. Next slide. All right, so that was a lot of information. And typically, when I am talking about mortgages, your wheels are probably spinning, but let's do a quiz. Name 3 common documents needed for mortgage approval. And we will take the winner from Facebook.
So there's
All right.
a little bit of a delay on Facebook. So let's give them a few more seconds.
Okay. Let's see if anyone was listening. Yes, I'm seeing some things in the chat. And that means you're submitting all of these documents. Many people want an update, but they haven't submitted everything. So we're going to submit all of our documents to the lender. Yay, I'm excited. All right, do we have a winner?
Unfortunately, we don't have any answers in Facebook. So we
Okay.
will just take a winner from Zoom.
Okay, sounds good. So Leanna, I hope I pronounced your name correctly. driver's license, social security card, 2 years tax returns, and bank statements. Sounds like you are ready for a mortgage. Thank you.
As soon as I said that, we got an answer in Facebook. We'll figure it out. We'll figure it out.
Yes. Okay, no problem. All right, so I am going to toss it over to Lisa. She is going to be our appraiser for the day, and thank you so much for listening.
Good morning, everyone. Thank you for being here today. We are going to talk about property appraisal. What is a home appraisal? A home appraisal is a professional, unbiased estimate of property's market value. This is typically done by a licensed appraiser. Lenders, banks mostly need this appraisal when they are approving a mortgage or doing a real estate transaction. Why do we need one? The lenders will need it for the value, to know the value of the asset they are lending on. So they would need to know what your house is worth. Buyers would need to know what the value of the house they're purchasing is worth. Next slide, please. How property value is determined. There are several different ways that the appraiser is going to look at to come up with what your market value is. The typical key factors that they look at is sales comparison approach, which is sales that are similar to your home and located in the area of your home. Same neighborhood or the same subdivision. If it's a condo, the same units. The condition of your property, meaning if you've done any upgrades, if you've remodeled or add square footage, or even add a fence or a deck, they're going to look at all of that. Location, location, location. Are you next to a golf course? Are you by a lake? Different things. Are you on acreage? Maybe you're on 5 acres, 10 acres. All those things are going to come into play on making or determining your market value. What is typically in the report? Typically in an appraisal report, it's going to be a description of your home. It's going to be pictures of your home. There will be a sketch because it would be physically measured. So they're going to give you a sketch in the square footage of your home. There would be pictures of all of your upgrades, anything you've recently done to the home. Then there's going to be a list of homes that are similar that just sold within the most, typically you want the last 6 months, but they will go out to a year if there's not many sales. So you will get it's like a sales grid, and it's a list of the homes they felt was more comparable to your home to help determine the market value of your home. That's how they come up with their final estimate of market value. There'll be maps in there on how far away those homes are, showing what's located around your home, flood maps determining if you're in a flood or not. And then, of course, there will be paragraphs or information in there about the condition of your home and things that you've done to your home. If there are damages or there are something concerns that they're concerned about, that will also be listed in there. Like if you have a leaking roof or something like that, that will be listed in there also. Next slide, please. Okay, so a purchase versus a refinance appraisal. Typically, the appraisal will be the same. It's going to be determined, the value will still be determined the same, but the two are used for different reasons. A purchase appraisal is going to be used when someone is buying something. So in what that appraiser is doing is coming up with the value of what the home is worth so that the lenders and the banks will know the money they're lending, that house is worth the money they are lending. When it is a refinance, the refinance is telling a lender how much the house is worth still, and if there is enough equity there for this refinance, if it's still worth the money that they're trying to refi on. So same appraisal, but just used for different reasons. Next slide. Okay, the common issues. You would know number one is a low appraisal. Appraisals, people will value their home or feel that their home is worth way more than what the opinion of the appraisal. So low appraisals is a big issue, and it comes in a lot. And you can dispute it, you can send comps. There's things you can do to try and address a low appraisal. Inaccurate comps, meaning they might not select comps that you feel are similar to your home. You can question that. You can send in comps that you feel are more similar to your home, and that appraiser will address those comps and let you know if they can use them, and if they can't, why they can't use them. Property conditions. Like I said, leaky roof. FHA is real strict on repairs. So if something is there, it needs to work properly on an FHA appraisal. So if you have a stove and it doesn't work, that appraiser is going to put, it had a range was there, built-in range, but it did not work. That's not so much on a conventional, but it definitely is on an FHA. The market could be up and down, so it's harder to establish what the value is. They might go further out than a mile, which, you might see on there 2 miles away. That appraiser should explain why they went out further. So those are there's a lot of other issues that could come up, but those are the typical ones that do come up. Next slide. Oh, we're already at the quiz. That was fast. This is time to win your prize. So, and to see how much you were listening. What is the main purpose of an appraisal during a real estate transaction? I'm not sure. I guess we're doing Zoom.
Yep, it looks like we got Donita Scott won. She was the first to answer. So go ahead and give us the right answer, and we'll get her gift card over to her once we receive her information. Congratulations.
All right, thank you so much, everyone, for being here today. I am passing it to Kirsten Matthews, which is our closing attorney.
Thank you so much. So good morning. My name is Kirsten Matthews. I am with the Halls Law Firm, and I am your closing attorney that I'm going to navigate today for you. So let's get started. We'll start with our first slide. What is a closing attorney? So many people are not aware that an attorney is involved in real estate transactions. However, the state of Georgia does require that all real estate transactions that are performed within the state, they must be performed by an attorney. The reason is because this is to protect the buyer. We want to make sure that we reduce the risk to all parties involved, but especially to our buyers, because you're the one, like I tell people, you're the one getting the risk. The seller is the one that takes the money and run. So as the slide shows, these are some of the responsibilities that we perform. So we review the loan documents. We conduct a title search. We clear title issues. Also, we coordinate final numbers and documentations with the lender. We coordinate with the agents about timing for closing, and we ensure that funds are dispersed because we want a funded closing, not a dry closing. Next slide. So let's talk about title clearance and title searches. So when a person is purchasing property, they should always check the title. And the reason is because a title search ensures that a person who is selling the property is the person who's able to sell such property. So in other words, there are times where people inherit property and they haven't transferred it properly. So it shows, hey, this was my grandmother's house and she left it to me in a will. But if it wasn't probated and there is no administrator or executive deed showing that they are now the owners of the property, that's going to show in a title search, right? So that title search just proves ownership and it proves a clear title. Without these two things, a transaction cannot close. Next slide. All right. So whether you have been to a closing table or you heard the horror stories associated with the closing table, you know, everyone tells you you'll be there forever. It's basically because of the paperwork, right? There's so much of it. But here is the good news. The good news is it is actually not as bad as you've heard. You actually can attend closing and leave within an hour so that you can start celebrating. But before we start celebrating, let's talk about what these documents are. So, document number 1 talks about the settlement statement and closing disclosure. So, the settlement statement is the document that the law firm creates. What it does is it shows the balancing act, if you will, of the numbers for the both seller and the buyers. Whereas a closing disclosure may be just your numbers. The closing disclosure is actually a document that is created by the lender. The reason why is because as a buyer, you will see it shows your loan amount, it shows your interest rate, it'll show the monthly principal and payment, but then it shows the actual payment. Because a lot of people have to remember that if you are escrowing your property taxes and home insurance, that is included in your payment. So one thing I'm certain my panelists can agree. We get a lot of people who say, oh, I want a payment to stay within this range. And they forget that range can't include, must not include property taxes, insurance, because those are things that we can't really change. What your taxes will be is dependent on the county. What your insurance is depends on the house and the location. So, but those are the things that are noted in your closing disclosure. The next document is your deed. It is signed by your seller only, but that deed is important because this is the proof you now own the home. So there are a lot of people who have this misunderstanding that they will not get their deed until they actually pay off the house, which is not true. You actually own your property as soon as you close. The difference is your lender is a lien holder. In other words, if anything were to happen, they note, hey, I'm owed money on this property. Yes, it's hers. Yes, it belongs to her. She's able to sell it or give it away as she sees fit. However, I should be paid off for it. So that deed is signed by the seller. It will note the seller's name and it will show that the property is going from the seller to the new buyer. And a good deed will list the property address as well as, most importantly, the legal description. The next document is your loan documents and your promissory note. Now, these documents, of course, are generated from our lender. These are documents basically to ensure that the lender is protected, because keep in mind, again, you now own this home in accordance with paperwork because your deed says it's your property. And you've given the money to the seller in order to buy said property. So what protects the lender from you just vanishing off into the sunset with this property? It's these loan documents. The reason why is because you're signing things such as a promissory note outlining the amount that you're promising to pay. It agrees to the payment amounts, when payments will be made, and even when payments would end. Additionally, you have things like the security deed, which is some rules, because like I tell people, security deeds basically are just legalese to say, not only do I promise to pay, I promise to preserve this property. So these are the things where we're promising that, hey, I will not get this house, knocked down a wall, and decide to make it an overgrown tree house. We're not doing that. We're making sure that this property can continue to appreciate because, one, we want it to appreciate, but two, your lender does as well. And the next document is title insurance policies. So there are actually 2 title policies that you would pay for as a buyer. The first one is a non-negotiable title, and that is your lender's title policy. The reason why is because your lender, again, needs to be protected. And so therefore, there is a title policy that says, should there be any liens or issues that are before the buyer or occurred because of the buyer, we as the lender want to be protected. And that is actually a policy that you as a buyer will pay in your closing costs. The second title insurance policy is the owner's title insurance policy. Now, though this is optional, I highly recommend this policy because how many times have you gotten into your car and says, I plan to get in a car accident? I'm certain you have never done that. The same can be said for if you buy a property. I'm certain you will never say, I sure hope I buy this property and someone tells me it's not mine, or they have this enormous lien that I wasn't aware of, and now I have to pay it. No one is looking for those type of surprises. And so therefore, this owner title insurance ensures that you'll never have to live with those type of surprises. So whether it is a lien or dealing with probate, this title insurance is a one-time payment that you pay to say that no matter how long or when it happened, as long as I own this home, I am protected. So short story, because I won't keep that long, but an example of where we were glad that people listened and got title insurance. There was a closing that we had that occurred at 10 o'clock in the morning. At 9 o'clock, a mechanic, basically a contractor who had done work on the home that was being sold, felt like he had not been paid adequately. He had gone down to the courthouse 9 o'clock that morning, like first thing in the morning, to file a lien on that property. Of course, no one knows this. The closing goes on at 10 o'clock without a hitch. And then maybe 2 weeks later, the new buyer gets a notice to say, hey, there has been a mechanic lien put onto your property, and thus you need to pay this person, settle, etc. Of course, the buyer has no clue who this person is, and doesn't know why she would have to pay them $10,000 for something she's never even contracted with. That title insurance says, don't even worry about it. Call us. We will do the investigation. You don't even have to call county for, to say, this is you don't have to do any of that. You call the title company and say, I got this paper in the mail. I'd like for you to handle it. And they say, hey, done. Have a great day. It's the best investment you can ever pay, especially when we're talking about spending hundreds of thousands of dollars on purchasing a property. My last document is affidavits and disclosures. These are a lot of things that, again, would be in your loan documents. The biggest one for disclosure is when we have disclosures about knowing what your numbers are, knowing what your home appraised for, and specifically if you are a VA loan, for example, knowing that you can't allow someone to assume. But if you're an FHA loan, it talks about ensuring that everyone knows that this person is buying under FHA. We're under certain rules that say that, hey, we have a mandatory clause. If the home doesn't appraise for a certain value, they are not penalized. Affidavits, a lot of times we run into are like name affidavits. We find out that a lot of times there are people who have very common names and they buy homes and they're very common names. And so when it's time to do a lien search, those same common names come up as, oh, you have a lien, you have a lien, you have a lien. A lot of times there's not their lien, but because it's their name, they have to do a name affidavit to say, hey, this is my name, this is not my lien. But again, few and far between. Here's a tip for you. If you have bought a home, will buy a home, currently you're living in your home. If you do have a common name and your deed is only in your first name and your last name, I recommend that you update it. Or if you're buying, make sure you include that middle initial. That helps break out those lien issues so that you can differentiate yourself from other people who are also living in the state. All right, next slide, please. So the next one we talk about is escrow and funding. It's everyone's favorite because, well, not the buyers. You're the one funding, but the seller is happy, and you are too. Why? Because you are buying a home. So yes, you may be losing money, your account goes down, but your value, your assets, if you will, go up. So in the end, trust me, you're winning. But there are at least 2 times as a buyer, you would send money to the law firm. So the first time could be when you submit earnest money. So when you go under contract, for example, there is an amount that you are promising the seller to show them that I am interested in this home. I'm serious. I'm looking to buy, and that is your earnest money. you can wire that to the law firm, and that'll be dependent on your contract. But the second time that you must wire your money or send it would be your closing costs. And this is important because our accounts are especially, specifically designed to hold your monies so that the transaction can fund properly. Because we, of course, don't want, you hear the horror stories about wire fraud, people sending it to the wrong accounts. This is why we are very cautious about how you send your money, but also understanding that we have an account where we're holding that money. It gains no interest. The money doesn't go out until all checks and balances are made so that we can fund properly. All right. And the next slide, I believe, is a quiz. All right. So I think we're back to Facebook maybe for this question. We're going to look for a winner. How about that? Right? So be ready. Here we go. Which professional ensures the legal transfer of property ownership at closing? Is it A, a realtor, B, an appraiser, C, a closing attorney, or D, a mortgage lender? And I know they're fast on Zoom. I'm not sure how they are doing on Facebook, but we got some people paying attention, and I love that.
Yeah, so the people on Facebook unfortunately have a unfair disadvantage, but we do have a winner on Facebook, Miss Mary Paris.
Congratulations, Ms. Harris. Excellent. All right, and then I have last slide. So in my last slide, finalizing the transaction at the closing table. So we want to make sure that you get to this closing table because your goal is to buy a home. And the process can be rocky, but our goal is to make sure that we can make it as smooth as possible by one, educating you today. So that way you can manage your expectations. You know what it is you're looking for. You know what can occur, what happens, the good, the bad, the ugly, so that you can better navigate. Because after all, if you are driving to location, you certainly get there faster when you know the way or you have a guide to get you there, right? And that's what this goal is today, to get you there. And so at the closing table, all parties are going to sign closing documents. We will disperse funds from escrow. The deed will be recorded with that local government. The buyer will receive keys and possessions, and of course, copies of the documents are distributed. But in all of that, let me also say this, my little personal tips, and I hope this helped. And that is this. When you are going through this process, there's two big things I like for you to understand. One, let's make sure that you are listening to your lender, because it is super important that you are working with them because they're the ones, of course, letting you borrow your money. Also, I know it may seem a lot, but create a brand new email account. I can't tell you how many times people have missed emails or they were slow responding because their email, oh, I got 15,000 unread emails. If you are serious in your home buying process, please make sure that you create a brand new email account that is only designated for this home buying process. Another thing that does is not only allows you to answer emails quickly because you know that every email you get is related to your home buying process, but it also cuts down on fraud because now fraud doesn't know this new email, right? It hasn't had a chance to be sold on the black market. No one really knows about it. So you are less likely to get that, get attacked from, spam or things that you didn't ask for. So that is my tips. I hope this helps. And now I'm going to pass this mic back over to Joni to close. Oh, I'm sorry, to close us out. I think this was my slide. I think I read Joni's slide and I'm so sorry.
It's okay. It's okay. We giving all the information oozing out of our ears to help our participants. So to wrap this on up, here is our last slide for this morning. So be prepared to, number one, trust your lender and your realtor. So I forgot to put that on there because these two people are going to make sure that you get to the closing table. So she did mention to you that new email address. That is great advice. So thank you, Kirsten, for that because I don't know about you guys, but I hate email clutter. So I will go through and erase everything and delete everything. And sometimes important emails get erased in there too. So that's a great tip. Check your basic information like your name and your address. As Kirsten mentioned, those middle initials are very important if you have those common names. Be prepared to wire your funds and have a personal check with you just for small amounts that may need to be brought to the closing table. And we cannot stress enough, buy your title insurance. Protect yourself, right? I always caution my clients that those are upfront costs that will save you thousands on the back end. So here's a little story. I had a buyer who was buying new construction. And you think when it comes to new construction, it's a brand new house, there's nothing wrong with it. There can't be any defects, right? I encouraged her to not only get an inspection, but also a survey. That was a $400 cost that the buyer was not happy about, right? $400 sounds like a lot of money. But during that inspection, we found out that her brand new construction house, was not connected to the sewer system. So can you imagine 5 months, 6 months down the line, and you smell something and you don't know where it's coming from, and then you find out that your home from this new builder, right, was never connected to the sewer system. So that $400 up front ended up saving her tens of thousands of dollars later on down the line. So these upfront costs can be a nuance. However, it goes for your protection. So always remember, reach out to a mortgage professional, your realtor to get you to all of the professionals in the mortgage industry that you may need for your transaction. So thank you all for coming and joining us. We will turn it over back to Deborah Kennedy, our moderator, and begin our question and answer session.
Thank you, thank you, thank you. Ladies, that was some great information. Absolutely. As a current homeowner, I wish I had known some of that before I purchased my home. So thank you, thank you, thank you. Um, Before we get to our Q&As, just to remember, we do have a survey that we're going to put up on the screen and also in the chat. We want you to make sure you give us your feedback so we can determine if we are meeting your needs. And also, Kirsten, one person did ask, in that example that you gave, did the person have title insurance? They were curious about that.
They sure did. Save them tremendously. And we tell people, you just never know. One thing that comes up a lot is the city of Atlanta specifically is notorious, is notorious for doing audits, realizing that they're behind on water bills. They do an audit maybe every 3 to 5 years, and then they find out, oh, so-and-so owes money. And then all of a sudden you realize, why am I getting a $10,000 water bill and it's not even in my name? Title insurance has saved so many people these crazy water bills that's come out of nowhere because, fun fact, water bills in certain counties title to the property. So they do become liens on the property. So it's a debt you would have to pay if you ever decide to sell the property or refinance. So yes, they did have owner's title insurance. It's well worth it, I promise.
Amen, amen. Good information, good information. Also, just a reminder, put your questions in the Q&A box, and we're going to go to the questions right now. The first question that we have is, can you purchase mortgage insurance at any point during the repayment portion of refinancing? Can you purchase mortgage insurance at any point during the repayment portion of refinancing?
So mortgage insurance, that is something that protects the lender. There's homeowners insurance, and then there's mortgage insurance. Typically, if you're getting an FHA loan, like I said, PMI that lasts for the entire term. So if you have that mortgage for 30 years, you're going to be paying mortgage insurance. It's a percentage of the loan amount. Typically, it's announced it's the same for conventional, or it's the same for FHA, regardless of your credit. So it's 0.55% of the loan amount that you pay each month as mortgage insurance. Now, when it comes to conventional loans, you're paying mortgage insurance if you have a loan to value of under 80% or less, meaning whatever the value of your home is compared to the mortgage, if it is 80% or less, then you have mortgage insurance that is usually put together during your mortgage process. And that percentage is based on your credit, which that is important to know because in some cases, someone may qualify for a conventional loan, but because FHA has a fixed mortgage insurance monthly payment, let's say if your credit score is right at 620, your mortgage insurance payment will be higher. So that percentage could be 1%, or sometimes I've seen 2%. And it doesn't make sense to pay that high of a mortgage insurance payment if you can change the loan product. So homeowners insurance is one thing, and then there's mortgage insurance that protects the lender in the event that you default. So that's why they have those flexible guidelines for lower credit scores. I hope that answers your question.
Yeah, that was a good distinction. Thank you so much, Allison. And we do have a question from Facebook as well. Do you get a copy or of the temporary deed or property title agreement at closing, or will the copy of the temporary deed be included with the closing loan documents? That was for our closing attorney.
It broke up. I'm sorry, I heard loan document. I thought it was Allison's.
Okay. So the question is, do you get a copy of the temporary deed or property title agreement at closing, or will the copy of the temporary deed be included with the closing loan documents?
So I personally will give you an unsigned copy of the deed, which doesn't do you any good other than showing the legal description. But yes, by law, you will get your deed. What my law firm specifically does, and this is every law firm may do it differently, but what we do is we e-record it. So we will send it out to the Superior Court clerk of whatever that county is. They record it usually within 3 to 5 business days. So then once we get that back, we send you electronic copy. But by law, you must get a physical copy. So after we give you that electronic copy, we will print out that electronic copy because it has the e-recording stamp, as well as the original. We will put them together and mail those to you. And usually we will ask you, like, where do you want it to go? We used to think, oh, everybody wants it to go to the new house, until we realized that some people are still sending things to their mama house or their P.O. box, and but so we have no judgment. You tell us where you want us to send it, we will send it, right? We just want you to get it. But yes, you will get it. But it does take time. You will not get it at closing because it does have to be recorded.
Okay, great. All right, next question. I have been waiting for rates to drop. I know they won't go as low as in 2020. Some lenders were telling me to buy and refinance later. I hesitate since it costs to do that. When does it make sense to refinance in terms of interest rate? And how much lower than the rate the homeowner is currently paying?
I think that's a great question. So there have been announcements that the Fed is lowering rates, and there's been a lot of talk about interest rates right now. So it's definitely important for you to understand what's going on. So there were rate hikes over the past few years, and that is something. Has anybody seen those alerts? The Fed has hiked the rates, and we're like, what does that mean? So whenever there are announcements that feds have cut rates, they're not specifically talking about mortgages, right? They're talking about the benchmark rate, which impacts lending overall. So you do want to watch the conversation about interest rates. And it's going to be important that anytime that you're considering refinancing, you're going to provide your lender with a copy of your mortgage statement. So that way they can see what type of mortgage you have. Typically, clients aren't going to know. If they purchased a house 5 years ago, they might not know if it was a FHA loan, conventional loan. And some people guess their interest rates, but just provide a copy of your mortgage statement so that way they can see the breakdown of your monthly payment. And then what they're going to do is see, okay, based off of this, where can we save you money? Because remember, there might be situations where you're paying mortgage insurance and you don't have to. So that's another option for you lowering your monthly payment or extending your term. So looking for an actual number, it's subjective, because if your interest rate is, let's say, 7% right now, you may benefit and save hundreds of dollars with a 1% decrease. Some people say a good rule of thumb is a 2%. However, you want to make sure that if your monthly payment is too high, let's say you're about to default and you're like, I can't afford this monthly payment, speak to a lender to see how can I save money. Because if I say wait for a specific number, you could have probably benefited from refinancing with just a 1%, a 0.5%. There has to be a net tangible benefit for a lender to refinance you. So that conversation, I was saying, go through a consultation and see.
All right. Thank you. Okay. Does the appraisal become a part of public records associated with the home once it's performed? Got an appraisal question. Does the appraisal become a part of public records associated with the home once it's performed?
It doesn't become part of public record. An FHA appraisal is attached to that property. I think it's 6 months to a year for that, but
6 months.
6 months for FHA, but conventional or any other type of loan is never public.
Okay, great. Thank you. Another question. Can a home buyer choose not to escrow and pay their taxes separately?
So yes, you can waive escrows if your program allows you to. It depends on the type of program. So let's say for FHA, they don't want you to waive your escrows because they want to make sure that you're paying your monthly payment. Even with conventional, if you elect to waive escrows, it's a higher risk loan. So your interest rate might be slightly higher if you decide to waive escrows. So typically, if I'm having a conversation with someone who wants to do that, I will let them know what their interest rate and monthly payment would be if they decided to include escrow, and that is taxes and insurance included in your monthly payment. The lender is going to collect, it's like a little savings account. That's the best way to describe it. So they're collecting your monthly payment, and they're going to send it directly to your homeowner's insurance company, or they'll send it directly to the county on your behalf.
Okay, great. Realtor question. I'm thinking about buying a home from a friend. Do I need a realtor for that?
I would recommend, yes, you would have a realtor for that, because even though this is your friend, right, there are still legal ramifications with purchasing a home, just like there would be from a seller that you did not know, right? And making sure that you understand the contract. So at very minimum, if you do not decide to hire a realtor, I would enlist the help of an attorney to ensure that I understand the contract language, right? Because things like this will damage friendships if you all are not clear on what the legal terms are on both sides of the table. So I always recommend hiring a real estate agent, but if you choose not to, at least get the help of an attorney so you understand the contract language.
All right, good answer. Thank you. Also, we had a request for you to repeat what you said about water insurance. What is it and what is it for?
So to be clear, it's title insurance. What it does, it protects you against water liens. So if the water can title, in other words, it can be a lien on your property. There are some parts of real estate that is public record, right? So you could go down to the county and you can say, hey, this is the property address. I want to see everything that's filed. One of the things you're going to pull up are liens. And the city of Atlanta, as well as some others like Cobb County, DeKalb, they do put liens on people's property if they fail to pay their water bills.
All right, great. Now, here's a question that could be for a couple of you on the panel. Another Facebook question. How much would you recommend to save when buying your first home?
You want to take that
I
one,
think
Allison?
that is a good question, um, because I'm going to get all in your business and ask for your bank statements. So that's one of the first conversations that we're going to have when you're going through the consultation is how much do you have saved towards a home purchase? This is going to let me know if I need to give you information about down payment assistance options available, check the requirements for local, national programs, because there are down payment and closing costs. Now, everything that I say is always going to be it depends, right? Because do you qualify for a $200,000 home? Do you qualify for a $400,000 home? So essentially, you're going to want to go through the pre-approval process to make sure that the amount of house that you're shopping online for and looking on TikTok at is the amount that you qualify for. So once we narrow it down and based with your application documents, and we're able to see, okay, based on your income and your debts, this is the amount of house that you may be eligible for. However, I cannot run your information through the underwriting system because you only have $1,000 in your account. So for this program and your credit situation, you're going to need a 3.5% down payment. Or I can get that 3.5% down payment waived with down payment assistance. But there still are closing costs. So if closing costs average, let's say 4% to 5% of the purchase price, we're going to say 5% because we don't know what your closing costs will be until you go under contract. It is going to be based on that property, based on the closing attorney that you select. There's a lot of third-party fees that we have to get. So I'm going to say 5%. I always pull out my calculator and I'm like, okay, our goal is a $300,000 house. So we know you're going to get down payment assistance. Make sure that your situation doesn't change and you meet the requirements. But for a $300,000 house, 5% is going to be $15,000. So is all of this money going to come from you? Do you have somebody that can give you gift funds? Or when you're putting in an offer, do you want to negotiate closing costs to be paid by the seller? Have that conversation with your realtor. Your realtor, before that when they enter the negotiation process, they're going to need to know that you need $10,000 in closing costs because you only have $5,000. You don't want to go under contract and then have the conversation later as far as where's the money coming from, because that's how loans fall apart. So we want to make sure we know how much you're eligible for, and then we're going to set a realistic expectation of how much you will need. Now, let's say if it's a situation where your credit score is on the lower end and you may have additional guidelines or requirements. That means reserves, right? So for higher risk situations, a lender may say, you need 3 months reserves. We will give you a loan for a $300,000 house, but you cannot deplete all of your assets to purchase this house. So if closing costs for this $300,000 house is estimate $15,000, we're going to get the seller to give $10,000 in closing costs. You need that five. Now, what's your monthly payment? Let's say your monthly payment is $2,000. 3 months reserves is the monthly payment times three. What if something happens? What if you lose your job? The lender wants to make sure that you have those reserves based on your credit history. So that means after we factor in funds for closing, we need to show that there's $6,000 still somewhere in your assets. That can be retirement funds, that can be savings accounts. So you want to have these conversations on the front end because a lot of times people don't think about that. They may say, oh, yeah, I do have a 401k. Let me send you my 401k statement. So, how much you're going to save, it can be subjective, but you want to make sure that you understand, does your loan require reserves? Um, do you need to negotiate closing costs? Don't go under contract and try to figure out the money later, right? But you want to know what you're getting into. So, Long-winded, but that is important to know.
And it absolutely is important to make sure you know what your resources are because they're going to be looking at all of them. Great. Here's
I
another
also
finance
like
question.
to, sorry, Kennedy. I also like to tell my clients as a general rule of thumb. So as Allison talked about, it depends on your personal situation. But for my clients during my consultation, I like to tell them the general rule of thumb is for every $100,000 that you are borrowing, expect there to be $1,000 for your mortgage, right? So if your home is $300,000, expect your mortgage to be somewhere around $3,000, right, per month. So if you know that your income cannot support this, even if you get approved for a $300,000 house, you may want to shop for something lower in a lower price range so that you can comfortably afford the home. Because the last thing we want is for you to be house poor. You do not want all of your income going primarily just to your to your mortgage payment.
Right,
I
great.
hope that helps.
Good financial information. Good financial information. All right, so here's a financing question. Are there financing options for non-traditional homes, such as tiny homes or modular homes? And if there are, is there a different process and where can I get more information?
All right, so there are financing options for tiny homes, modular homes, manufactured homes, um, condominiums. There's so many different options available. So typically what you want to do is reach out to a licensed mortgage professional and let them know your scenario because everything is scenario based. Um, Try to give as much information as possible. That way they can send you guidelines and information because with those non-traditional programs, it's going to vary. The qualifications are going to vary based on lender. And for example, I'm a direct lender, so we have internal programs. However, we have the option to broker out to about 40 plus lenders. So there may be 5 lenders that have options for tiny homes. And then it's going to be my job to go to those lenders and their account executives, get their guidelines and understand their guidelines. So that way I can see which option works best for you. So there might be multiple credit score requirements, multiple down payment requirements. And that's the same for any non-traditional program.
Right? Also, there's a question on what areas in and around Atlanta are tiny homes able to be located? What areas in and around Atlanta, counties, municipalities, are tiny homes able to be located?
So that would be a realtor question. So you're going to want to check zoning requirements, but you have to either do your due diligence or if you have a realtor that specializes in those items, similar to if somebody is interested in a USDA loan, they can reach out and say, hey, Allison, I know I want a USDA loan. All I can do is give them the website and then they have to find a realtor that specializes in those areas and finding out those type of homes. I'm
And
the
it's all
money.
dependent upon the parcel, right? So the tiny home has to go on a piece of land somewhere. And like she said, you will check those counties and see where you can place those things. But of course, you would need sewer hookup and an electric hookup for that. So it depends on a parcel of land where you're thinking about putting. Does it already have utilities available, or is there digging that needs to be involved to connect sewer lines, or is this tiny home going to stay mobile? Is this something that you may want to move in the future? Then you might want to look into renting land like you would with a manufactured home or like a mobile home park, right, where you can put this. So it all depends on what your situation is and what you're looking to accomplish with a tiny or modular home.
Okay. All right. Another question. What are funded closing and dry closing? And how long are loans held?
So,
Okay, two separate questions. First, what are
yes.
funded closing and dry closing?
So a funded closing is a closing where we received all the money. The lender, of course, is submitted their funds to the law firm, but also the buyer, if you're having, for example, closing costs that you have to pay at closing, you've wired those money. So that way we're able to inform everyone at the table all monies are in. So therefore, once we get the approval from the lender to fund, we can send all the money out. A dry closing will occur where we don't have all the funds. And it can be for, particular reasons. It can be because the buyer didn't wire in time, or maybe the lender informed us ahead of time. We have to have all the documents in before we even send it. And that's probably going to be a day process. So we will not fund this until the next day. There are times where people, for example, Columbus Day is a federal holiday, or Indigenous People Day, excuse me, is a federal holiday. And the law firm may be open because people are like, no, I still want to close, but the banks are closed. I can't send you money because the banks are closed. So we would do a dry closing. You're closing where you're actually signing documents, but no funding goes out until the following day.
Okay. And then this question is asking, how long are loans held? I'm not quite sure what you mean by that, because I know you can have a 30-year, 15, whatever. So if you want to give a little more explanation on that, we'll get to that one. We'll move to the next one. How do you combat appraisal bias issues? How do you combat appraisal bias issues?
You're going to be working with your lender on that, because the appraisal goes to the lender first. If there are issues that arise from once they receive that appraisal, you can get a second appraisal. If they can dispute that first appraisal and document where the bias, what was the bias, what happened, you can always get a second appraisal to compare to the first. And some lenders will pay for the second, some lenders don't. I mean, it varies from different lenders how they handle that, but the appraisal will be done for the lenders. So I'm pretty sure at that point the lender is going to be involved. Correct me if I'm wrong, Allison. They'll be involved in determining if this is a bias appraisal and what's the next step. If you got the appraisal on your own and you're not connected to a lender, then you can turn it in. You can go to the appraisal board and actually have them to evaluate the appraisal and help you in that area.
Okay, and then just to add to that, so when an appraisal comes in, it can come in multiple ways. We're going to scroll down. I like to see, how did the appraisal come in? Is it as is? Is it subject to repairs? Is the appraisal value low? So when you say bias, those are some of the things that people may be concerned about. If the value is less than the purchase price, then we cannot lend higher than the value of the home. So let's say the appraisal comes in low and they're like, I know my house is worth more. Or if, the seller wants to rebut the appraisal, typically we're going to ask for 3 comps to submit for review. And comps, that is 3 comparisons, comparable properties that have sold within a certain time frame. As Lisa said in her presentation, typically within 6 months, they're looking at comps as well. They have comps, comparable properties that they have on the appraisal. So you're going to send things that align with the purchase price. That way we can review it. And there are some cases where it's a unique property and they can't find any comps, right? So it's going to be important for, if the seller feels that their value is as so, submit it. It's very important that you understand the loan product because, again, when they said FHA, the appraisal sticks, what that means is every property is assigned an FHA case number. So if there's an appraisal done, even if a new buyer comes along, they're going to be able to see that previous appraisal and that value. If it comes in low, if the appraiser is signing off that this is a low value, it's going to stick to the property. So in most cases, the appraisal management company will reach out to the lender like, hey, do you all want to reach out to the agent to have them provide comps? Because, I know that this appraisal is going to come in low. And if I sign off on this number, it's just going to be, it is what it is situation. And when we talk about second appraisals, not all the time will a lender accept a second appraisal. So it's important to understand the loan program, what is the issue, and it's always best that if we can get the appraiser to change their mind, which it's their name, their license, a lot of times they're going to stand by their value, but you can always try. Understand the program and the process.
And
I would also say too,
most appraisers will look at the comps that are provided and try and explain if they don't feel those comps are similar or what they would choose. They will give you an explanation or try to explain why they didn't use it or why they wouldn't use it. And there's a lot of times they will. If it's a good comp and it fits and they feel it should have been used, they'll add it and change the value. It is worth the try.
yep. I would also say too, if for on a refinance side, I would advise that you go through and remove any personal items, family pictures, and stuff like that when your appraiser is coming through. Just because we do know that the world we live in, there could be some racial biases in there. So I always like to tell my clients personal pictures, family pictures, take all of that down when you know your appraiser is coming. So that way they don't know who lives in the house and they are only strictly looking at the property.
Okay. Ooh, that's some good answers. Some good answers. All right. So a little clarification on that. How long are loans held? Clarification is when a pre-approval occurs for a home loan. How long is that pre-approval good for?
All right, that is a good question. So pre-approval is again a snapshot of your current situation. Your credit is good for typically 90 days or 120 days, depending on the program. So that means the lender does not have to repull your credit if you close on your home and your pre-approval, all of those things. It's a credit pull. How long is your credit good for? However, your pre-approval also consists of your income documents. So if, let's say, you provided income documents and you've changed your job or you've worked less hours and we're using variable income, that can impact your pre-approval and your approval. So I try to let people understand that it's not necessarily how good is my pre-approval for, because if your situation changes tomorrow, your pre-approval is done, right? However, if your situation has not changed, then you should be good. Even if somebody, let's say they don't find a house within that 90-day time frame, I'm not going to repull your credit after 90 days. I'm going to follow up with you, might get some additional documents just to make sure we're still good. But you can continue to shop on your home. And then once you do go under contract, we will repull your credit. So hopefully that answers your question. And then, like I said, there are also additional reports that are pulled during the mortgage process. So even though we don't repull your credit, if you have any undisclosed debts, if you apply for anything, those will still be shown to the underwriter during the underwriting phase. And some people will say, well, did you repull my credit? We didn't repull your credit. We have access to your entire life until you close.
So here's a question right along with that. Does your credit score need to be higher than the minimum required because the initial credit check drops your score and the process takes so long?
So when it comes to inquiries, again, typically you'll never see the same credit twice. Credit is a game. It's always going up and down. As you make your monthly payments, your credit score is going to go up. What's important to note is that inquiries do not impact your credit report like late payments. So typically for people who are on the borderline, it's not necessarily the inquiry that's impacting them. Maybe you can get some guidance on, there are certain credit simulators that we can run that let you know things that you can do to improve your score, and they're very specific. So it may say, pay off this Chase card from $800 to 508. It's very specific. So if you know that you're a borderline and you're afraid that your score is going to go under the requirements, then you want to speak with your lender to see, okay, what are some things that I can do while I'm shopping to improve my score? So that way, if you do have to repull my credit, I'm in a better situation.
Also, when it comes to your credit, there are 5 main elements that they look at for your credit score. The most important is your payment history. So inquiries do affect your credit score, but at a much smaller rate. And if you are looking for a mortgage or a car loan, the FICO score has figured in there within a 30 to 45 time frame. If you have several mortgage companies or companies pull your credit score, they know you're looking for the best interest rate. So it only looks like one inquiry and not 4 or 5 different inquiries. So it does not adversely affect your credit score. Like you got Sears pulling it and Macy's pulling it and all of those people pulling it. But within that 30 to 45 day time frame, if it's a mortgage company or a car loan company, they know you're looking for the best interest rate. Okay.
Yes.
All
And can
right.
I add one more thing to that? Buying a house helps your credit as well because the diversity of mortgage, well, products on your credit report. If you're borrowing hundreds of thousands of dollars and you're having a good payment history, that is going to take your credit from, let's say, 600 to 700. So think of it as a improvement plan as well for credit.
All right. Next question. Can you change from one lender to another? I heard one presenter state a down payment percentage for investment property at a rate lower than I was quoted from my current mortgage holder. So can you switch?
So I do a lot of rescue deals. I will say use the word switch. It depends on in what you mean when you're saying switch, right? So let's say if you're in the middle of the mortgage process and you're not seeing that you're going to qualify for a loan, your realtor may advise, hey, we might need to switch lenders. That means allowing somebody else to look at your financial situation to see what program that you qualify for, see what your interest rate will be. Whenever you see anything with a minimum, it is subjective. Just because that is the minimum interest rate or not interest rate, minimum down payment, your minimum down payment might be 20% because of the type of program, could be because of your credit. Everything on the mortgage side is related to pricing. Every interest rate costs, right? So when someone is asking about interest rates, there's not just one interest rate that pops up. There's going to be a list of interest rates and pricing that we're going to look at. So let's say if someone has a 780 score, their pricing for their interest rate might be better at 15% down. So they can put 15% down. However, let's say if your score is on the lower end, the cost for your rate may be 2%, 3% because it's a higher risk loan. So these percentages that I'm talking about factor into closing costs. So discount points, rate buy downs, all of those things that factor into that 5% average of closing costs that we try to keep you in. If the cost for your interest rate is higher at 15% down than 20% down, then a lender may say, well, your down payment needs to be 20% down because it won't make sense for you to put down 5%, 15%, and pay all of these additional closing costs that you wouldn't have to pay if you just increase the down payment to 20% down. And so that's why in most cases, your lender or your loan officer has to be a mortgage nerd because there's a lot of numbers that factor into communicating all of this stuff to you. So doesn't necessarily mean that I would be able to give you a lower amount, but you can always get a consultation to see what is your minimum down payment, especially for conventional, because remember, it's an umbrella. It's more so investor based and situation based.
Okay, I think Joni answered this question, but just in case somebody wants to add to it, since other factors are at play other than principal and interest of the mortgage payment, what can you recommend for figuring out what one can truly afford? Joni gave the $1,000. Anybody else want to add to that?
So it's important to understand the market for whenever we are pricing loans or we're looking at the max debt to income ratio that you're allowed, we have to look at estimate taxes for the area that you're looking into. I'm licensed in multiple states, so I have to know that, okay, I know that Texas, they're pretty close, usually around 1% taxes. However, if I cross that Mason-Dixon line and go into Baltimore, those taxes are going to be higher. So I can't give out a pre-approval with the same mindset that I'm giving out in Georgia and Maryland. So research is going to be important because we have to factor in those numbers when we're looking at your maximum that you can afford. Another thing to consider is if you are going to get a property with a high HOA, an HOA, those figures have to be factored into your mortgage payment. So when people are getting maxed out and they're like, oh, can I go higher? Can I go higher? And you bump them up, it's important to have those conversations because, hey, right now we have estimate taxes and insurance. If you breathe and go over 56.99%, which is typically the maximum for FHA, the underwriter is not going to say, oh, it's okay, they're just a percent over. They're going to send the loan back to the lender or to the loan officer and say, hey, this loan is not approved. You need to restructure it. Now we're stressing, trying to figure out, okay, how can we get you back down? Do you need to pay off some debt? Do we need to lower your insurance? Because the taxes are what they're going to be. The HOA is what it's going to be. So you want to make sure that you're understanding the market, the type of property, and everything is a question mark until we get to the closing table. So you have to have some wiggle room and flexibility for final numbers.
And can I add on to that just for like 2 seconds? Keep this in mind too. A lot of times what we see is when we, the law firm, we will send like a tax certification to the lender because they're trying to get an estimate as to, hey, this person is buying their taxes. I got to buying this property. I need to escrow it. What are the current taxes? We give them 2 numbers. We tell them what the current taxes are, and then we tell them the taxes without homestead, right? There are a lot of people who have homestead exemptions on their property, so therefore you're paying less in taxes, which is great. But when you first buy that property, if you don't go and file homestead, which is something that, people will remind you, but we can't make you do it. So if you fail to do that, that means you are paying the higher tax rate. And so as the closing attorney, I got to make sure that Alice and team know, hey, when you're doing the numbers, here's what it could be, like the highest it could be, because we can't promise that you'll actually file homestead. And you need to keep that in mind because a lot of times you'll see, like Zillow is probably the worst culprit. I said it. We're not taking it back. Because they'll give you this example like, oh, you can afford this house. And they give you these unrealistic numbers and it's not based off anything, but you can do your homework because again, real estate, a lot of this is public information. You could type in somebody, like if you're saying, listen, I'm interested in buying this house, you could go onto that county's website and see what the person's been paying in taxes. It's not a secret, but keep this in mind that what they're paying in taxes, there are people who have senior exemptions. They have VA exemptions. So their taxes may not be your taxes. So what you were thinking you would pay based off my neighbor, this is a person who bought the house 12 years ago. And so they're basing their taxes based on what the house was valued 12 years ago. You now are buying it at an appreciated value. Your taxes are going to go up. So keep that in mind because taxes is a driving force where a lot of people all of a sudden now can't qualify for the home because the monthly payment's too high.
I have got to piggyback on Allison and that homeowners association. So for the future homeowners, please take a look at what are the rules and regulations of that homeowners association before you purchase. It's not just as a beautiful house, I love it. You best check the rules and regulations because once you buy into a subdivision with a homeowners association, you are subject to all of those rules. And if you do not follow those rules, you will be fined and or lien put on your property and or some people's homes have been sold from underneath them. Not trying to put fear in you, but knowledge. That homeowners association bylaws and covenants, very important to know and understand so that you know what you're getting yourself into as far as living in that community. And then of course, they can go up. The fee monthly, quarterly, yearly can go up depending on what's going on. So just wanted to add that in. Okay, a couple more questions before we end here. Another Facebook. How do you get out of the required mortgage insurance? Allison, I had heard If you did put 20% down, once you got to 20%, that you have paid enough that you don't owe more than 20% on the property, you can ask to have it removed. Is that true, folklore, or you just stuck with it?
Yes, so it depends on the program. So, mortgage insurance, if you have FHA loans, FHA is going to have mortgage insurance for the life of the loan. So, the only way, if you have an FHA loan, to get rid of mortgage insurance is to refinance into a program that does not have mortgage insurance based on your loan to value. So, conventional loans, you can not have mortgage insurance if you put down 20%. That means your loan to value will be 80% or less. But nowadays, people are not putting down 20% because everything is high. So, a way to get to 80% loan to value a lot quicker is home values are increasing. So, for example, people can refinance after a year and sometimes be able to drop mortgage insurance because the value of their property has increased so much that they are at 80% or less, right? So if you have a conventional loan, you don't have to refinance to drop mortgage insurance. Let's say you put down 3% or 5% and you're looking at these properties sell and you're like, I think I'm at 80% or less. You can call your lender, your mortgage servicer. That's who you pay your mortgage payment to. You can call them and say, hey, can you evaluate my loan? Because I believe that I'm at 80% or less, and I think that I should have my mortgage insurance dropped. Sometimes they'll do it automatically based on certain evaluations that your lender does. But if they can get you to pay it, I mean, who's going to call quicker? I'm going to call quicker, right? So you want to make sure that you are paying attention to that and you can call. Or if you have a product that does have it like FHA, then you can refinance into one if you feel that your home value has increased.
Okay. Another quick question, Allison. I'm a hairdresser. I do not have W-2s. So how would I go about getting an approval for a loan?
All right, so I love self-employed buyers. So shout out to you, entrepreneurs. So there are traditional programs and there are non-traditional programs. So for the most part, if you go the traditional route and you're self-employed, they're going to want to look at your tax returns. They're going to look at your net income, not your gross. And I have so many conversations with people like, did you know that your tax advisor was expensing all of your income? And because of that, a lot of people do not qualify going the traditional route because when they look at the number, they're like, wait, I make $100,000, but I only am showing 20% income, net income, or I'm showing negative income. I see a lot of negatives. So people feel like, okay, well, I can't buy. They have come out with so many different programs to help self-employed buyers. A popular one is a bank statement loan that you may hear about. So with these bank statement loans, they average your deposits into your personal account, or you can even do a business account. And based on your average deposits over a 12-month period or 24-month period, sometimes there are even 3-month period bank statement loans. It's letting the lender know, hey, this is your income that we will use, but the down payment might be larger. Typically, down payments for bank statement loans are 10% down if you have a credit score of 700 or higher, or sometimes for lower scores, it can be 20% down. It just depends on your situation. But you have to consider, okay, do I want to pay the IRS to claim more income? Or do I want to go the bank statement loan route and do a higher down payment? And a lot of people are choosing bank statement loans over paying the IRS.
Great, great. All right, as we're getting closer to wrapping up, let's go ahead and put the speaker's information up on the screen. So if people have additional questions, they can go ahead and reach out to them. And I will ask these last few questions that we have. The last couple of questions, one, homestead exemptions. Is there a deadline to file your homestead exemption? And is there an age for the homestead exemption?
Rapid fire questions. Answer, yes. Deadline is April 1st. However, as of July 1st of this year, there has been a new extension. So deadlines are still April 1st. However, when you get your estimated property taxes, if you file an appeal because you forgot to file homestead, your homestead deadline is extended now to the appeals process. So in short, the appeals process usually starts in June. It ends like July 15th or something that way. So then you got an extension. So 2 bites at the apple. April 1st is the first deadline, but you can file an appeal and extend it so that you can still file for homestead for that year.
Great. And then one person asked, they just bought their home in April. How soon can they refinance for a lower rate? Just bought it April 2025. How soon can they refinance for a lower rate?
All right, so most traditional programs do not have a prepayment penalty, which means that there is no technical waiting period to refinance. However, there has to be a benefit to the buyer, right? So that means the benefit is lowering your monthly payment, doing a cash out refinance. Sometimes cash out refinances have certain restrictions where you have to own the property for 6 months in order to do a cash out refinance. However, if you have inherited a property, then there is no waiting period. So depending on the situation, there might not be a waiting period. But if you're just trying to lower your monthly payment and do a rate term refinance, what is the benefit? The benefit would be to lower your monthly payment. So if we can document that we're lowering your interest rate, reducing your monthly payment by dropping mortgage insurance or anything like that, then you can refinance at any time. When interest rates dropped and they were 2 and 3%, people were refinancing a month after they purchased their home. So hope that answered your question.
And then the last we have has to do with that HOA that I just mentioned. One question wanted to know, how do I find homes that do not have an HOA? So just so you know, new buildings now are going up in subdivisions which do have homeowners association, but you can reach at Joanne, your realtor, and
Yeah,
she
I
can help you
answered it in
filter
the
out.
chat for her, but your realtor can definitely set
Oh,
you up on a drip campaign. If you are using Zillow or Redfin or things like that, there are filters on those websites to filter out homes that have HOAs on them. Of course, when you have your consultation with your real estate agent, and you talk about those must-haves, if that's something that you do not want to participate in, then we can filter out those homes that do have HOAs on them.
okay. And then the last question was, can a potential buyer get the covenant prior to closing? Absolutely. As a matter of
Yes,
fact, before you put your earnest money down to purchase a property and it's in a HOA, you need to ask for them at that time to review them so that you
correct.
can make a decision if you want to live in that community. And a lot of times they're online, so it wouldn't
They
be a
are
problem
online.
for them. They can get it to you. Okay.
Yep.
All
Most
right.
HOA covenants are listed in FMLS with the listing. So realtors will have access to them prior to you even making a decision on if that's the home for you.
Okay. So on the screen now, you have the contact information for all of our presenters. Would you help me give them a hand clap for the awesome information that they provided during this session? It was really great information. I know I learned a lot as well. So thank you, thank you, thank you, ladies. The survey is in the chat. And also, we're going to put up a QR code for the survey, and you will get an email later. We want your feedback. I'm telling you, it's important for us to know if we're meeting your needs. So, thank you again for attending this valuable informational seminar. We want everyone to take advantage of home ownership, but you need the right information to do so. And so by coming here today, you got the information. So now go back, look at your finances, reach out to the resources that we have here today, and make your decision. Thank you so much again, and enjoy the rest of your Saturday. East Point College Park Alumni Chapter out.